here we go with the S&P trade. We just got hit on one contract only at $10.30. Yes, it is a 1220 put. Yes, it was done live. Yes, the closing on yesterday was $26. The high today was $15.70. And as we continue to go into the bull run to the 1220 resistance, we thought we would be the low print of the day. We have taken our capital risk out of that trade. That trade there, if you do the math to our entry from that closing bell and they opened up and someone just bought $1 ahead of us at 11:30, because why? If the S&P pulls back below 1220 at that resistance level, it gave us the affordability to be the low of the day. And because of the low entry, that takes out a lot of risk. The people that were short the S&P in the bull run at 1220, buddy, they lost all that premium down. Look at how cheap we got it at SMF, because we did. And the thing about it is, I will do the S&P 500 chart. I've already updated that chart. And this video will go with those two daily and weekly updates as to how we took out the risk in an entry at the low of the day. But did we get exuberant? No. We did one contract because we're in a bull rally. And bull rallies, we've been having calls up and out of the money that are working well in the bull rally. So why can't I buy some puts now against my bull rally? That's what I did. So if I gap down tomorrow and this goes up and I lose some money in my call, my S&P bull calls, so what? I'm on this side of the market at the low of the day, just as I was at the low of the market on the call side 7 days ago in a 7-day rally. Okay, and then trying to eliminate my risk. These contracts are down $14.80. That's a $1,480 savings to my entry on one contract. If I was trading 10 of these, then I would have just saved $14,000 of risk of my entry. Nobody will deny the fact that when you're using the risk management that other people do not use, when you use correctly, you get to take out that risk and you get to be that low of the day. And it was done live, it was done here, and it was done now, and it was done gracefully, I must say. We have the S&P 500. We have a short-term reversal up here right at that resistance of that 1220. We came down here to 1216. Not a big reversal. But once again, each one of these are 74 cents a teeny value. And the thing about it is on the S&P, we've just been doing nothing but breaking higher all day like we have for 7 days in a row. And we have. What we did over here was take a very minimal amount of risk by getting hit on the low of the day at 10:30. And then someone bought $1 higher at 11:30. And being a market maker is, how do I get the low of the day and take out the risk? I'm going to cap this video off. That's the S&P. It's above the diamond, so it's having its reversal upside move. But our entry, 96 contracts traded at resistance at the 1220 mark in an extreme bull rally, only taking a market maker reversal to support. We will throw that if we come up and we can't get above these major diamonds here and close above them, that diamond starts right here where we had a reversal, but it goes straight across here to this teeny line, right into these two diamonds, and all of these diamonds right here, that's going to be your upside volatility resistance. S&P at 1217.50 handles right now. 21.96 handles on the day on the S&P 500, going into an hour and 10 minutes left in the market. And how do we limit out? But how did we get the wholesale to limit dollar cost risk? I can limit out higher over here at any time and take my profits.